Welcome to episode 40 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Michael Kornman of Align Collaborate. Max, what did you think of our conversation with Michael?
It was great to hear from another capital provider. I thought he offered all kinds of insights for independent sponsors and for us as well, being a newer capital provider in the space. But for me, the most interesting point that he brought up related to diligence, and I always kind of hone in on diligence, obviously because of my background, but he mentioned the use of market studies as part of Align's diligence efforts, and actually said that he wishes that he had done a market study on every single deal he has invested in. And that says a lot. I mean, that highlights the importance of these studies. And they're not cheap, and that's probably the reason why a lot of sponsors don't do them. And I would imagine also that sponsors sometimes feel like they are the ones performing the market study as part of their diligence. But Michael highlighted how good these market study firms are at producing the studies, and they're running from $60,000 to $150,000. But what they focus on is very specific to the deal, the strategic alignment between the sponsor's value creation plan and the deal, how to accelerate the thesis to sort of post-closing. This is obviously super important for a sponsor who's trying to figure out whether or not this is a good investment and whether or not they're going to be able to execute on their plans. So I thought that was a just great piece of information. And it was something that we hadn't really heard before.
Yeah.
I would inject on that and say, I started my career at Bain and specifically doing private equity due diligences for middle market private equity deals. And we would charge, $1, $2, $3 million for 5-week projects and do a very deep dive commercial diligence of the target and the market they were in and the competitive positioning. And why? Well, it's the perfect materials to have at the IC level for any given private equity fund. There's a lot of CYA involved with having due diligence broadly across the spectrum. And I think it's a sign of the lower middle market professionalizing when you hear capital providers requesting it. That said, I couldn't fail to recall our recent conversation with Ian Reynolds, who made the opposite point, I think, if I remember correctly. Help me out here. He said something down the lines of one of the reasons we're able to buy lower middle market companies at the low valuations that exist is because you have to be able to get comfortable with certain outstanding risks, meaning you're not going to be able to quantify or document every open-ended risk pre-closing. There's a little bit of a leap of faith involved in this market. And of course, you're more budget constrained because the deals are smaller. Unlike EQT, you can't absorb a $2 million commercial due diligence with Bain as part of your closing costs. Even $60K can be quite hard when it's out of pocket for independent sponsors. So I think every independent sponsor needs to strike the right balance here. And Kornman, of course, knows this. But as we are a capital provider too, of course, the more due diligence, the better. It's always more comfortable. But someone who's been in the space as long as Kornman also understand that underlying dynamic, that it's not realistic necessarily in every situation.
So I was reminded of our conversation with Nathan Chandrasekaran, who talked about one filter that he recommends independent sponsors use when choosing a capital provider is only to choose those who literally use the phrase independent sponsor on their website, which demonstrates, which signals that capital provider is committed to this space, cares about their reputation in this space. You're not getting sort of fly-by-night capital who might just be doing a deal, your deal, and doesn't really care about their reputation among the sponsor community. So in Michael Kornman and Align Collaborate, we have the polar opposite of that. We have a large fund from two experienced independent sponsors who saw a gap in the market to provide a capital solution specifically for the idiosyncratic needs of independent sponsors. So they really have put a stake in the ground as the leading capital provider that is ground up for the independent sponsor ecosystem. So just want to underline that we were thrilled to get Michael on here. The one other detail from our conversation with Michael that I'll note, he talks about them being relative value investors as opposed to absolute value investors. They're looking at the delta between an entry multiple and a potential exit multiple, as opposed to whatever the entry multiple is. In other words, they're prepared to make investments in high entry multiple deals, so long as, of course, they think that the exit multiple is going to be sufficiently high as well. Interesting note of contrast with Minds Capital. We don't have a mandate to be absolute value investors, but we sort of de facto are. When we look at our portfolio so far, the average multiple is what, 5.1, 5.2, Nicholas, for all of our deals?
5.1x is our average multiple, just below.
5.1?
Across our whole Fund 1, yeah. Across the Fund 1 portfolio, I think we're just between 5.0 and 5.1x, yes.
And we have found that sort of anchors us to want to stay in that range and not want to go higher, even when there might be a deal that is trading, at 7x, but and the sponsor thinks that there's room to get to 10 and 11 and 12x. So it kind of made me realize that whether or not we intended to, our orientation is to be absolute value investors at this stage in our life. Would you agree?
It depends. I think I've been in the HVAC industry for a long time, for instance, and it's actually completely feasible today to say that we are doing a great deal at 8x. If you're buying a clean 3 million EBITDA residential service company in that industry for that price. Similarly, it's quite feasible to buy a small software company that is priced at 3x ARR and say that, hey, we're doing a good deal. But it's also a little bit of a pyramid scheme in that you're doing that and you're making a bet that someone else higher up in the hierarchy will pay more down the line. And I think when you have a lot of experience and track record in the industry and have earned the trust like Michael Kornman has at this point, you have more credibility behind these kind of assessments, because the investors will trust that, yes, he will guide us to that kind of outcome. They know what they're investing in. And even though 8x sounds like a lot for a blue-collar services commoditized business offering, it isn't when you look at the broader context of the big players trading at 20x. So we understand that dynamic too. But that said, with Minds Capital, we've also found that nothing really beats a low entry multiple in terms of creating value, and more importantly, creating value right out of the gate. So you're effectively in the money right away when you close a deal that is below market. And our average has been 5x, so we've gone above that, of course. I think we've stretched to the high single digits in certain cases that have been more tech-oriented. But one consequence of us being diligent or being disciplined on the entry valuation has been that we, for instance, haven't participated in a lot of software deals that are based more on ARR and revenue multiples versus EBITDA. So it's a strategic choice. I think relative valuation matters, but then you're playing the market and timing a little bit versus absolute measures are, I think, time tested and absolute, right? They're not relative, they're absolute. So
I would just add that as you become a much larger fund and you're deploying a lot more money, you're going to get into bigger zones. So inevitably, you're going to be buying $5 to $15 million EBITDA companies on the entry. So you're just going to pay more for those. I think as you have more capital to deploy, you're going to be experiencing those valuations, and you have to be willing to look at the higher zones and then where's the next exit zone up from there. So I think Align is a $200+ million fund. In some cases, they're simply just dealing with larger deals.
Well, before we turn to Michael, a reminder that Minds Capital invests equity in independent sponsor deals. So if you are a sponsor with a deal under LOI, please submit it to us at mindscapital.co. Okay, here is episode 40 of the Minds Capital podcast with Michael Kornman of Align Collaborate. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Michael Kornman is a household name in the independent sponsor community. Based in Dallas, he and his brother Grant formed NCK Capital, which became one of the pioneers of the independent sponsor model. Over a 10-year period, they acquired 5 platforms across trade schools, facilities and environmental services, and value-added distribution. They've had a spectacular exit from that portfolio, and the rest of the platforms are mature. Several more exits are expected in the near term. More recently, he launched Align Collaborate, a $233 million fund providing bespoke equity solutions to independent sponsors specifically. Michael generously shares a lot of deal flow with us here at Minds Capital, and we have been happy to co-invest alongside them in a few of those deals. Michael Kornman, it's great to have you on the Minds Capital podcast. Welcome.
Thanks. Great to be here. And Nicholas, great to see you. And Will, thanks for doing this.
Absolutely. Michael, you were at McGuireWoods recently, as we were. Any takeaways from the 2-day extravaganza?
Well, it's definitely the Super Bowl of independent sponsors. It was a crazy event, just like it always is. Incredibly useful and productive, and it took me a few days to recover after the event, which is it's just a whirlwind. So I couldn't believe how many people were there. It was the biggest thing I've ever seen.
Have you been to all of them?
Every single one since the first one. We originally started out, there were a few independent sponsors in the McGuireWoods break room in the morning with donuts and coffee, and then they decided to do a conference in their office, which was, I think it was 100 or maybe it was 200 people. And I remember Grant talking to John Finger and saying, "I cannot believe you found this many people that were interested in the independent sponsor model." So yeah, everyone since the beginning.
Well, so every year the refrain is, wow, I can't believe how many people are here, even when there were just 100 people there. This year that was closer to 2,000. Do you think it continues to go to 3,000 and 4,000? At some point, there's going to be a ceiling.
It doesn't feel very niche anymore, does it? It's
right.
It feels like a big conference, a big industry. I think it's going to continue to grow. I mean, it's just a great model. There's so many different reasons to pursue it. It's gaining exposure. I think it's going to continue to grow.
Have you noticed whether the composition has changed on the sponsor side of attendees in terms of who's done deals that are there versus who are trying to do their first deal?
It's really a great blend. It's the term independent sponsor is so broad. I mean, Nicholas, you remember back when we used to be called fundless sponsors when back in the day, which was kind of an objectionable label. But today independent sponsors are folks that are spinning out of funds that have been fund GPs that are doing deal by deal for a variety of reasons to folks that are graduating from the search fund model, or that are folks that have run portfolio companies for private equity firms and are out hanging their own shingle, trying to do deals of their own. So it's crazy. There's just so many different folks. There's super experienced folks that are independent sponsors. There's newer folks that have angles or skill sets that would be great for creating value in portfolio companies. It's just so many different flavors.
And at Align, when you're at something like a McGuireWoods, but really just in general and in building relationships with sponsors, do you kind of want to talk to everybody, no matter where they are in their journey into independent sponsorship, or do you really need to focus your energy on already established sponsors, or sponsors with at least with a live deal, or how do you think about your own deal flow really when engaging sponsors who want to talk to you?
Yeah, at Align Collaborate, we're a pretty small team here. There's 6 investment professionals, and so we have to be mindful of our time. But we really want to get to know everybody. The folks that we tend to not spend or spend less time with, the search fund folks. They're just not. They're pursuing a model where they want to run a business, and sometimes those folks do come to the conference. Love seeing them there. Ultimately, hope those folks become independent sponsors and get some experience that is applicable to sponsoring a deal. But we really have to, I guess we want to meet everybody, and we do our best to do that. But it's we do look and see who's got types of experience or the depth of experience that would be the right fit for us.
And are you doing the speed networking yourself, or would that be the 5 or 6 other investment professionals?
Oh, no. We're all all 6 of us do the speed dating, do the one-on-ones. It's critical. I mean, it's so important to just get to know folks through those meetings. They're fast and furious, but yeah, absolutely.
Any tips on that? Because we talked about it a little bit offline, and Nicholas was more strategic about his than I was this year, and so I was lamenting that I could do better. How do you approach it at the beginning of a McGuireWoods?
Yeah, so we definitely go through and do some kind of curation of who we're going to meet with. I think there's a couple of ways that you can optimize. You can find, if you're an independent sponsor, you can find capital providers that you think have overlap with your, areas of interest related to investing. Like there are folks that are more healthcare oriented, and there's folks that are more technology oriented. And at Align Collaborate, we have a broad mandate for primarily B2B products and services, but in certain cases we'll look at consumer, in certain cases we'll look at healthcare. I think really spending time and making sure you understand the types of capital providers that are attending and who's the right fit. We do the same with independent sponsors. We'll work with all types. That's kind of part of our model. But I also think that having like a really tight talk track for your meetings, but not like pitching, I like to get to know people during these meetings, and I know it's a really short time frame, it's window, and you're really deciding if you want to meet with somebody else again. But I think it's just a natural conversation with a light talk track is really the right way to proceed there. I mean, it's sure you can get a little monotonous, saying the same thing over and over again, and it's just good to find out a little bit more about people during those one-on-ones and what they've been up to.
How has the difference been for you, as you have been both on the independent sponsor side of that speed network, and now more recently with Align, you're on the capital provider side? What are the differences? How has the experience been?
Yeah, I mean, it's been fantastic. At Align Collaborate, I like to let people know that I was an independent sponsor. So I've walked in their shoes and probably attended that conference more in their seat than in my seat today. And so it kind of takes the pressure off for them to pitch me. I just want to have an authentic conversation about what they're up to, and how they're thinking about investing, and what their value creation angles are, and their past experience. It's been helpful to kind of share that experience.
If you go back to the coffee meeting with donuts at McGuireWoods, the very first one, when you said there were 9 of you, I think I joined the year after. At that time, the independent sponsor model, it wasn't established yet, of course. It was not deemed as very attractive. The capital in circulation is much smaller than it is in high finance. A very heavy lift operationally, very people intensive to be in small businesses. And in general, the capital markets or capital access was illiquid and restrained. But now, of course, all of that has changed. And you are contributing to that. Minds Capital is contributing to that. And in general, it's now a proven model. And so you're saying that this is now attracting some of the best talent from high finance. You also see the entrance of Alpine and Shore that really go down market in terms of buying companies. My question, is there a world where first-timers and searchers are crowded out in the lower middle market?
Ultimately, deal sourcing is very relationship oriented. So I don't think so. I mean, independent sponsors are fantastic at finding creative ways to build relationships with sellers. And so I think there's opportunity for everybody to be successful. I think that, the search fund model is a little bit different than what we do. So I can't really speak to that, but independent sponsors, if you're looking at, let's say a $2 million EBITDA company to a $10 million EBITDA company, it's really about the relationship built with the seller and your own way to explain that you're the right buyer for that business. So I think it's independent sponsor. When I was an independent sponsor and Grant and I were independent sponsors, it's not an efficient sourcing process, right? These are long relationships. You spend a lot of time with people, and you really have to understand what their hot button issues are and their needs as a seller. And so I think that creates the opportunity for just about anybody that's willing to spend the time to do it to be successful.
So if you look ahead to the conference in 5 years from now, what are the changes that you would expect?
Oh gosh. Just there's more at the McGuireWoods Conference. I think there's just going to be more people. I mean, I don't know how much more capacity they have. That they seem to have filled out the Fairmont Hotel pretty completely. But so I assume it can get bigger. I think that you're going to see other conferences. We already there's other market participants that are putting on events that are super high quality. But I don't know. You talk to the McGuireWoods folks or whether they're going to do a second conference or split it, or they're pretty tight-lipped about it. But I think that there's also the content in those conferences. I used to think was less important, and now I think there's actually some real value to the content. I was always really focused on the one-on-one meetings, but I think that there's probably going to be continued development around that as well.
What is behind your observation that the content has more value now than it used to?
It's just there's different kinds of independent sponsors, and like I mentioned before, there's that moniker or label is means so many different things. You've got folks that have substantial expertise and experience as maybe a former private equity CEO that need more content around kind of how to structure a deal. You've got folks that are super experienced that are spinning out of funds that may need some guidance around kind of the differences between operating at a fund and operating as an independent sponsor. I think that's something, no matter how sophisticated folks are, I do think there are differences in the model, and whether that's using service providers that are part of the independent sponsor ecosystem when there's and the benefits to that, or whether it's the cadence and pacing of deals and how they differ, how they can sometimes differ. I think that it really depends on the type of sponsor and what they're where they are in the arc of their career.
I think you observed that there were some sponsors in your network who didn't attend the conference this year, who maybe have been regular in the past. Why would that be?
I think people are busy, and I do think that over time, folks develop relationships with their preferred capital providers and check in with them and talk about deals on the regular. So I did have, it was crazy as many people as were there this year. There were there were a number of people that we knew that weren't going, and they just thought their time was better served. They were either in the middle of a deal or just were focused on something else. So independent sponsors at some point, they depends on how they build their team. They reach capacity, right? Like they may have a full portfolio, whatever that means to them. And so I think that folks were focused on their portfolios and doing a deal is just a starting line, right?
Can you share more about what capacity looks like? What are some rules of thumbs to how many deals any given independent sponsor can have in their portfolio?
It depends on a few things. I think that, when you see independent sponsors that have substantial teams, that gives them the ability to there's independent sponsors out there with 10 companies in their portfolio, but they have substantial teams with folks in different roles, value creation, deal execution, and so Grant and I think we had 5 or 6 portfolio companies at our peak, and that was a lot. But we had junior team members that were super helpful, and then we also there were operating folks that were involved as well.
So you were 2 senior partners at NCK Capital, and you peaked at 6 portcos. So 3 per senior partner. Is that the ballpark?
Yeah, I'd say that's a good direction. That's directionally correct. I mean, it just depends on where the companies are in their hold period. Obviously, you have to do a ton of work up front to post acquisition to get the company set in the right direction. There's you're building relationships with the management team, maybe building the management team. You're sometimes redefining the go-to-market strategy. Sometimes you're focused on building the add-on acquisition engine and doing the corporate development. I mean, it's much easier. Some of those portfolio companies that we had been around a few years, so they were lighter lifts than the early days, and I think that's a key consideration.
As an investor, do you ever run into independent sponsors where you question whether or not they have the capacity?
Well, we certainly think about it. I mean, it's kind of self-regulating. Most independent sponsors want to do a good job. All independent sponsors want to do a good job with their portfolio companies. So, they know what their constraints are. They understand that they really don't. You're not gonna build wealth and make money if you're not building value. So I think it's a bit self-policing, but we do think about it, and we do ask about it, and there are conversations around like, hey, what's your bandwidth look like? How do you spend your day? It's an organic thing. It's not like an interview, but you get a sense of where people are in their portfolio.
What's your view on when a sponsor comes and says, hey, I have 2 deals under LOI that I'm working on two different platforms? How do you react to that as an investor?
Yeah, it depends on how big their team is. If they're multiple partners, that's a common thing. We see that with more senior or experienced independent sponsors. If it was a brand new independent sponsor and they'd never done a deal before and they had 2 under LOI, you'd kind of ask yourself, well, how are they going to manage that? So, if it's an independent sponsor that has, significant, full cycle investment management experience, then, there's ways to manage it. It's not like in this world, there's no hard and fast rules, about those sort of things. You just want to make sure that the sponsor's kind of considering how heavy the lift is post-close.
And as you evaluate sponsors, what are some of the things that you look for? And maybe more importantly, what are some of the things that may come up that is a pretty orange flag from your perspective when you are working with new sponsors?
If you've never been a C-suite executive or an investment professional, or built a business as an entrepreneur through from soup to nuts through exit, it's pretty hard to be an independent sponsor, and if you've never done one of those three things. So, you never want to tell. You want to be encouraging, and you want to be helpful, and you never want to be negative. But you do have to have the skill set to do this. The being an independent sponsor is you're a private equity investor, and you're creating value through these portfolio companies. You have to have a skill set and an angle to do that. And, you can't just want to do it. You got to be able to do it.
What do you mean about angle?
Either business model expertise, have invested in a similar business model, have grown a business, and have, like, for example, if you're in residential services and you've built an HVAC business, and now you want to be an independent sponsor, and you've sold your HVAC business, that's, you understand how to hire, lead, develop technicians. You understand what creates value in that model, how to grow that business. As an investor, if you've invested in tech-enabled services, and you understand all the growth levers there, and you understand what value creation looks like. We really appreciate when the sponsors start talking about what they're going to do with the business and how they're going to grow it in a very detailed way from day one. Like, that's super important. Whether you're a new independent sponsor, whether you're super experienced, as a PE investor, it's all about what are you going to do to create value, and that's so many different things: organic growth, M&A. A lot of these businesses need, they're founder-owned businesses, and they need people, process, technology, improvement. I mean, you really want to make sure that you're creating a platform that is attractive to an upmarket buyer.
And how do you weigh creating value post-closing versus buying at a really good valuation multiple, for instance?
Well, they're both important, right? Like, you gotta buy things at good valuations, but that means so many different things. I mean, we're relative value investors. We're not absolute value investors, and so it's
what
really
does that
about.
Mean?
It means like, we're not tied to a particular multiple. We don't have to keep a multiple below a certain threshold. We're looking for relative value, an asset that will be worth more in the future than it is today, and can be grown. And maybe there's fragmentation for add-ons. There's low-hanging fruit related to organic growth. There's a clear path to acquiring customers or creating deeper relationships with those customers. Could be anything.
Are there any differences in how you diligence target companies now as an investor versus how you diligence them or screen them or filter them as an independent sponsor?
Well, we really sit in a support role here at Align Collaborate. So we're very much relying on the independent sponsor to lead the diligence. Now we're doing our own work in parallel in a way that's very collaborative and helpful, we hope. But I guess there's, you're doing the usual diligence. You're also doing a lot of commercial diligence, and we're spending a lot of time on that growth. Whether it's an M&A pipeline, whether it's defining adjacencies. One of the things we'll do that we think makes us a little different is, in many cases, we'll be helpful and sign up for broken deal expenses, and that can include also a market study. If I were going to go back and do something different than what I did before as an independent sponsor, I would always do a market study. It does so many things. It helps you create alignment with the management team. It helps you define kind of the helps you with the 180-day plan. It helps you define go to market. can help you build a pipeline of add-ons. And so, but they're expensive as all get out. So, it's hard to pull that trigger as an independent sponsor. And, we believe that it's really important, and we're happy to help with those in many cases.
And what does one of those look like? What's the anatomy of one? And you said they're expensive. Can you give us a range?
Yeah, I mean, you can get them done for, a very, very light one for, I don't know. I've seen partial ones for $65,000 or $70,000, and they can go up into the hundreds of thousands. Most of the time, it's probably $100,000 to $150,000, depending on the vendor you use and the scope of it. And it contains generally a market map. It contains a discussion around adjacencies. It talks about company positioning, product positioning, service positioning, or just the usual market study components that are helpful in figuring out strategy on the go forward.
Michael, so you started as an entrepreneur yourself. You and Grant became independent sponsors. We'll want to hear that story, but I think we'll work backwards. Tell us about the origin of Align Collaborate. So why did you go from independent sponsor to now capital provider? In fact, one of the leading, most well-known brands of capital in independent sponsor land.
Well, that's nice of you to say. It's a long journey. This may be a bit of a longer monologue, so cut me off if I start to ramble. So Grant and I started different paths right out of school. I was an entrepreneur. I built 3 businesses with Grant, but I started a restaurant company right out of college, built an air freight business, and Grant and I built a consumer a point of purchase finance business together. And Grant had started his career in private equity, and so he had that experience. And we were looking for our next entrepreneurial endeavor, and he's like, we should go buy a business. And I was like, well, that's great. We have some capital, but we didn't have enough to go buy a big mature private equity style business. And he goes, we'll just go get a private equity firm to give us the money to do this. And I'm like, what private equity firm's going to give us money to go buy a business? And he's like, hold my beer. And so so to his credit, we started down that path. And so we printed out business cards. We got the URL CKN Capital, which are the names of our daughters, Claire, Kate, and Natalie, and order of age, oldest to youngest. And Grant calls me, and I don't think I was in the office that day. And he's like, hey, I don't think this is going to work. I was like, what? He's like, let me send you this email, this URL. And it looked like Chicken Capital. And so I was like, yeah, that's definitely not great branding. I mean, I know you can do the color and the rock and the tree, which is customary in private equity, but we were trying to do something else. So we rearranged the letters and got NCK Capital, which is a significant improvement over Chicken Capital. And then we started hunting for deals, and that was calling investment bankers, brokers, networking, and we met a friend who was a private equity investor, and he said, hey, you should go talk to this banker. It was a middle market bank. That had this deal that they had not been able to sell, and it wasn't because it was a bad company. It was just the business was frankly a little smaller than what they were used to focusing on, and they didn't have the contacts that would be interested in a $2 million EBITDA business. So and that's how we got started. We invested in a trade school business. It was the largest cosmetology school here in Texas, and that was how we got started.
And Michael, so this was the first time that you and Grant had partnered?
No, we'd worked together at those operating businesses before, and worked together for a long time, and so we had a track record and history of success together. And it's great to be able to work with your brother. People ask how we do it. We have a great time, and it's a fantastic team, and we built a fantastic team here at Align Collaborate. And so over time, we saw as independent sponsors the model evolve. And you asked how we got to Align Collaborate. So we saw the model evolve, and we thought that there could be an improvement on the model for providing equity capital to independent sponsors. There's so many different types of investors in the independent sponsor ecosystem, and they're all great, and they all have a reason to exist. I mean, you have SBIC funds, you have family offices, you have controlled private equity firms that are partnering with independent sponsors. But if you're looking for a non-control equity partner that really understands the model and is growth oriented, there was a gap in the market. And so we've known the Align guys for a long time, and they're absolutely fantastic. And so we partnered up with them, and we launched Align Collaborate, and it's been just a fantastic partnership and journey. And the Collaborate fund is separate and apart from the Align Capital Partners PE fund. We are a separate team, separate fund, but it's great because our job is to be supportive to independent sponsors, and that means a bunch of different things, right? Support can mean everything from staying out of the way and making sure that you're minding our role. We fundamentally believe the independent sponsor is the most important person in the transaction, and so we respect the independent sponsor, and we believe that you can't step on their toes. And so we're really want to make sure that we're participating in an appropriate way, which depends on the type of sponsor, the situation, but knowing to stay out of their way is a huge way of being supportive. And then it also can mean providing resources to accelerate value creation. And one of the things that we eventually moved towards when we were at NCK Capital is picking capital providers that were really the right fit for the deal and had industry or domain expertise, could be helpful in value creation. We take the same approach here at Align Collaborate. We do have access to the folks on the other side of the house. We have a fantastic talent partner here. He's just incredible, and he can help our independent sponsor partners with recruiter relationships and recruiting executives if they wish. Everything we do in that way is a pull model. We don't push anything on any of the sponsors. It's totally optional. But that's another example of a way we could be supportive if appropriate. But we're very, very mindful of respecting the independent sponsor role because they're the most important person in the transaction.
And so when you and Grant contemplated this move, it was because you saw a gap in the market that needed to be filled. So it was actually, in some ways, it was entrepreneurial. There's a solution out there that wanted to be created, and you guys were well positioned to go be the ones to do so.
Yeah, we just thought we had we have a native perspective on the market. Yeah. We've walked in the shoes of the independent sponsor. We understood what their fears and concerns were. We understand what their wish list looks like, and also their what they wanted to stay away from when it came to capital and relationships. And so we thought that we could build a better mousetrap here. And the Align guys were and the Align team here has just been incredible. It's been a lot of fun to be part of Align Capital Partners.
What do independent sponsors want to stay away from on the capital side?
Independent sponsors are rugged individualists, and they're out. They want to do their own deals, and they want to lead those deals. And so you never want to be marginalized as an independent sponsor. You never want to be told to sit in the corner and keep your hands in your lap. You've sourced a deal, you built a relationship with a seller. You're very protective of that relationship. If it's a proprietary deal, I mean, there's or through some sort of could be some sort of process that's limited, and as an independent sponsor, we were always concerned that we'd bring a capital provider or to a meeting, and they would screw it up. I mean, like, you've spent all this time building a relationship with somebody, and the guy walks in who's got the big fund, and you want to make sure that they don't say the wrong thing that's off-putting, and so we're very mindful of that. And then, if it's a more experienced independent sponsor that maybe have spun out of a fund, we may or may not be at those meetings, and they just want more. They just want more latitude, and that's consistent with our model. I mean, we're more of like a specialized LP for them.
How would you know whether or not the capital provider will have good bedside manners when they meet the sellers?
You got to talk about it, right? Like you got to when you go into these meetings, you got to pregame, and you got to role play, and you got to ask what they're going to ask, and there should be a lot of discussion around that issue. It should be something that's brought up if you're lucky enough to get invited to one of those meetings as a capital provider. You have to make sure that we as capital providers and LPs to independent sponsors always prompt that discussion to make sure that we're serving the independent sponsors' needs in regards to that, and also understand hot button issues and sensitivities with the sellers. Like, is there anything we should stay away from? Is there anything, I mean, like these independent sponsors have gone through like a lot of diligence to these sellers, and like you never want the seller to think you're going to put them through the ringer twice. So,
Michael, what has been among the surprises going from one side of the table to the other?
Just the different styles and the different strengths of the various types of independent sponsors. I mean, like you think one type of sponsor, and there's just so many. They all have different. There's so many different impressive skill sets and toolboxes, and folks are creating value with technology, with sales and marketing in a very kind of deep and detailed, structured way. There's folks that are really understand the end markets of these companies deeply, and so they know where what add-on acquisitions are really transformational for a company. I mean, I guess just the diversity of the model is probably the answer.
You mentioned that at Align you have a support system for your independent sponsors, and that it's something you don't push on them, but it's available if they need it. I think you mentioned recruiting capabilities as one. I imagine these are need-based, right? So the independent sponsors come to you because they need this kind of support. If you were to rank all the things that you could help with, back office, front office, transactional, how would you rank them from the most needed to the least needed?
Well, it's important to say that there are a lot of sponsors that don't want us to do any of this. That's cool too. But I think talent is if you're buying a founder-owned business, hiring the right executive team and making sure they're the right fit for the business is critical. Technology. A lot of times you're transitioning from a QuickBooks situation to a true ERP situation, and there's any sort of support related to technology implementation can be helpful in certain cases. There's certain sales and marketing best practices that can be deployed that independent sponsors are very interested in and having support on. But I just want to be careful, because it's when I used to hear that folks had operating support, it was a dog whistle for they were going to step on my toes, and And so we are like really deferential and careful about that. It's not a have to do thing around here. It's just an optional toolkit that, if we can be helpful, that's great. If it's not appropriate, then, we're fine standing down.
Michael, the size of Align Collaborate, we mentioned 233 million. How did you arrive at that size?
Yeah, I mean, look, we want to make sure that we're in the lower middle market, right? Like that's and it's important that we can write a check that's appropriate for the lower middle market. We love the lower middle market, and we think that this is where a ton of the alpha is, and we believe that this is it's kind of like a religion for us. The lower middle market is our playground. And so, to mix metaphors, but it's really driven by making sure that we can remain relevant and not being pressured to write checks that are too large.
With our fund one, we saw our average portco closed at 4 million of EBITDA. I think when you have a fund of your size, I would have to imagine you also participate in deals that are bigger than that. Is it your understanding that, as the independent sponsor community grows, they also work on bigger deals overall? And what are some of the bigger creatures you see, and what's the max that you see these days, and so forth?
Yeah, we can go up to 15-ish plus million of EBITDA on when we start, but there's independent sponsors working up and down the spectrum. I mean, you see folks that are exclusively focused on much larger deals, but we also are really good at providing follow-on capital. So for growth, whether it's organic growth, whether it's add-on acquisitions, that's one of our superpowers. And so we can upsize our check based on that. But yeah, there's definitely folks that are really focused on bigger deals, and I think that as more people spin out of the mega firms, that's definitely a part of the market that will continue to grow.
Is there anything about the independent sponsor model that makes it a better fit for the smaller end of the lower middle market versus middle market deals, or is it equally applicable in both?
There's so much inefficiency in the lower middle market, and it allows independent sponsors to use that kind of relationship-based sourcing that we talked about earlier. And so when you get farther up market, it just becomes more competitive. There's fewer proprietary deals and it's just there's a lot more banked, super competitive banked processes. And so there's definitely a place for independent sponsors in that world, and you can folks that have relationships that can source deals that are very large are out there, and there are people that have done it successfully for a long time. But it's a different ecosystem, and requires a different skill set.
Michael, we've talked about how to make transactions happen and what makes a good independent sponsor and how they should think about onboarding capital partners. Let's turn the table and talk more about the exits. You've had an exit yourself. You've seen many transactions go through the full life cycle. I think it's fair to say that capital is coming into this market because returns have been competitive. They naturally need to be more competitive than liquid options such as the S&P 500. Yet they're not quite as lucrative as they can be in the VC world, where you can have 1,000 baggers every now and then. So where exactly do independent sponsor deals fall within the return spectrum?
Wow, that's a tough question. I mean, look, anecdotally, independent sponsors generate great returns, and when we one of the things we embarked on when we started this initiative was we called all our friends like you, Nicholas, and begged them to tell us about their returns, and it's really mostly about access to a different part of the market that's generating these great returns. I mean, it's like I mentioned before, some of these are proprietary deals that are just not accessed in traditional intermediary networks. And so, I mean, you hear about, 3, 4, 5, 6, 7 times MOIC deals regularly in this space. Now, it's you have to be careful because it is anecdotal, and you want to make sure you're capturing the bad ones too, because
Exactly.
not everything's roses, but we believe that the independent sponsor ecosystem is interesting because independent sponsors source deals better, and that can mean higher quality businesses at lower valuations. It can mean businesses that have more low-hanging fruit and growth through professionalization, and that ultimately generates very, very attractive returns. And it's frankly it's a different set of deals than a lot of the lower middle market firms are accessing, and that's why I think that's why you see so many other firms coming in and exploring in the independent sponsor ecosystem.
And based on your personal experience, what does it take to raise your eyebrows? Is it a 3.5x net or higher than that? Like when you speed date with people and they say, here is the return I got on a previous deal, at which point does it go from within the range of normalcy to being like, wow, well done. How did you do that?
Yeah, I think if you look at a base case of 3 times, after independent sponsors, capture their economics, that's an awesome return. So I think that's if you look and underwrite growth that cases with higher returns than that, but that's a solid starting point for sure.
The recent Axial report revealed that terms for independent sponsors, meaning the carry they charge, I think in particular, seems to be improving at the expense of the capital providers then, right? Does this resonate with what you have seen?
Well, my question about that is, who are they surveying? Because if they're surveying independent sponsors, I would be aspirational, I guess is the best way to say it. I mean, look, I think that independent sponsors, back to our view of them being the most important person in the transaction, they should get paid like that, and there's a market for economics, and I think it's more or less the same as it's been for a number of years. I mean, I think that ultimately independent sponsors get in good scenarios get paid like private equity firms. It seems to be pretty stable, and I don't see that things have changed tremendously in the past few years. I always wonder when you look at that returns data, like what kind of deals they are, what kind of capital providers, what kind of sponsors. Like there's just so many questions around that. But ultimately, I think to be a great capital provider in this ecosystem, you have to pay market economics. And if you're not doing that, and you're trying to chisel independent sponsors on economics, that's a bad thing.
I feel like my opinion is that I think kickers on the upside seem more common than perhaps they used to be in the past. But another thing that is happening is that as the deals grow, the carry actually comes down a little bit, say from 20% to 15%, just because the AUM is much bigger and the capital providers have a little bit more influence because they're writing much bigger equity checks.
There's a number of factors that go into carry structures. They're highly bespoke. Could be deal size, it could be valuation, it could be how attractive the asset is from a growth attribute standpoint. It could be the sponsor. There's just so many things that go into that.
Well, Michael, speaking of which, you had mentioned your first deal with your brother, the trade school, the cosmetology business in Texas. I know that has performed well. Can you kind of give us a bit of more of the story? We always like to get a case study out of our guests before they leave.
Yeah. So we were introduced to a banker at Stifel by a friend of ours who said that he had this company that he was interested in selling. That was it was owned by a private equity firm that was managing capital for a pension fund or a teacher's pension fund, and this was kind of an orphan asset. Like it was smaller from an EBITDA standpoint than the other assets that they were trying to sell, and the banker, who's awesome and incredibly sharp and skilled, just it was a smaller deal for them, and so they were less focused on it. And so we went in, and there was it was an interesting time. There was some regulatory noise around the trade school business, and we basically could see that you could comply with all the new rules, and it didn't have a substantial impact on earnings, even though it seemed like a scary overhang. And so this team was kind of, frankly, I don't know, they just weren't getting supported by their current sponsor, and so we went in and partnered with that team, and it was a great partnership. We kind of re-energized them. They still run that business today. They're awesome, and we the trade school business has a direct response marketing component to it, and they were spending a lot of money, millions of dollars a year, on direct response television. And we basically recognized that, like, an 18 to 24-year-old female that wanted to go to cosmetology school was not sitting at home in the middle of the day watching Judge Judy. And so we helped them redirect that spend to online digital marketing, and that's something that we had deep expertise in, as former operators. And so it got that flywheel going, so we were able to start attracting new students and really deploying more of their resources into attracting students, and also improving the student experience and the education experience, which is critically important. I mean, it's ultimately your product, and you have to make sure that it's a highly regulated business. You got to make sure your outcomes are great, and the students are getting jobs after that are paying them well, and and it's a bit of a non-traditional student, so they need different types of support than maybe a traditional college student would need. And I mean, it's ultimately a trade education. So we really that business grew, I don't know, by roughly 3x, and it was we exited that investment in 2021. So it was really great. It's doing fantastically well today. And we're still in touch with that team, which is nice.
And that one lever of changing the customer acquisition channel from Judge Judy to Google AdWords, was how much of the value creation do you attribute to it?
It's I think it was a substantial catalyst for value creation, and certainly a big part of it. There was a whole kind of alchemy of what was done that was related to the student experience and the facilities, and just really serving the student in a more thorough and high touch manner. So I think that I'd say a substantial part of it was driven by that, but a substantial part of it was driven by just improving the product and the outcomes for the students.
Well, congratulations on that one.
Thanks.
Well, Michael, we're over time. Thank you for giving us a little extra. We really appreciate you coming on the Minds Capital podcast. We love the fact that we are able to co-invest in some of your deals. Great that you and Nicholas have years of knowing each other, but we really do appreciate you being a guest here on the podcast. So thank you very much.
Well, I'm honored that you all would invite us, and Grant says hello, and we really appreciate everything you all do for the community, and honored that you would include us, especially now that we're not independent sponsors anymore. So
that's right. You're a vendor, Michael. We don't usually even have vendors on, so
it's very very cool that I was able to do this. So thank you very much. Very grateful.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsored deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.